Hey, Larry Berman here with a paid advertising for Diet Coke. No, I'm only kidding. Radar is really jammed this week, folks. there's the market retested the summer lows. We thought that was a very real risk. Weeks ago had we been warning about being very, very cautious. But as we look through our crystal ball this week and take you into our chart room, you can see that there's a lot of things not to be bullish about for sure, but probably a little bit of relief coming. Let's have a look. So here's our S&P 500 chart. You can see the little hammer-like pattern for those of you who are technically inclined. You can see the test of the lows. We went through the closing lows from June, and while the markets weren't crazy bit at the end of the day, there certainly was a tendency for the market, to turn and look a little bit better. Jay Powell was at his best again today. So Jay Powell started speaking at 2. Initially, markets didn't do much. Then again, he got on his hawkish talk again. We broke the previous lows earlier in the day. We ran down to those levels, again, going back to the June lows. And it's really very important here that the market didn't take those out. So, when we talk about markets being auction markets, one of the things that I learned when I was in the futures pits, years ago when I was a much younger version of myself trading commodities and financial futures, cleaning out the stops was a big part of the markets, day to day. The market knows where these levels are. It's not a surprise why everyone puts stops under there. The fact that we couldn't take those lows out was important. The fact that the market caught a little bit of a bid into the close of a weekend was a little bit of a positive. Bullish? No, but a little bit of a positive. Some of the key sectors that did something similar is what we see in industrials. The transports have been underperforming dramatically. And again, we're heading into a recession, right? So transports had a massive bounce, got above the 200, failed. The market didn't get above the 200, come back, again, hit those levels. If we look at what this level means and going all the way back to this gap, what is that gap? That's Pfizer Monday back in 2020. Very important chart point for the industrials. Again, let's blow it up here. Tested the level, it held. We had bought some put spreads on the industrials up in here. We covered the long end of the put spread today, and we left our naked puts exposed to earn some income over the next month or so. So those are some of the things we do in our private client ETF portfolios that we just don't do those things in public mutual funds. So that's pretty interesting here on that behavior there. When we look at some of our pro eyes indicators and we look at market breadth, so whether we're looking at the percentage above the 50 or the 200, again, down to deep oversold levels. If you look at, again, the relationship to the June low, slightly higher low. Again, not fist-pounding bullish, but a little bit of a divergence there. Okay, so that's something when we look at our pro eyes indicators and the sum of them this week on what they're telling us, the opportunity perhaps, maybe a bounce perhaps. Again, I'm not saying the bottom's in. No way, no how can anyone say the bottom's in here. But for a bounce, maybe for a month or so, okay. We still have earnings to come unglued and everything else like that over the next 6 months. So, bounce potential of the market, I'm starting to see it. Let's have a look at what vol is telling us. Well, the premium in vol markets, the spread between the front month VIX and the fourth month VIX does not get as high as the June lows. You can read that in a couple ways, folks. More intense, more intense, more intense, less intense. So you can read that as there's no capitulation yet, which is one message for sure. And you can read it as a divergence, meaning even though we tested the low, the panic and fear was not as intense. See, there's that divergence in there. Here's the z-score of that spread, and you can see it didn't reach that 2 standard deviation capitulation level that we generally like to see. So very interesting from that point of view. So with all that in mind, bull and bear picks of the week, what are some of the things we did in our portfolios? It's been a long time since we said we would look at gold. We cut our positions. We've been net sellers on rallies for a long time. I like silver, way too early on it. I still like it, but we're under some pain now. But when we look at the gold miners here, the GDX, one of the trades we put on today in our ETF portfolio for clients, we wrote a put for a 20 strike out to next March. Why next March? Because by next March, we will have hit the terminal funds rate. In other words, the pressure probably on the bond market is over by then. It might be well sooner than that. Once we see the stress come off yields, gold probably has another day. And once the market starts to price in easing, gold has another day. But so we wrote the put for a percentage of the portfolio at 20. We took that premium. And for March, we bought 29 calls. So that sets us up to buy the dip between now and March. Should we do that? But if the dip doesn't come, the call potential here and the upside is very, very interesting here. So we like that for the bull pick of the week. Here's another one on the bull pick of the week side. Look at the performance of the public listed private equity ETF, PSP. It's a name we talked to you about a few months back, where we were putting some of this into one of our funds. We played a bit of a bounce. We got out of it. So oversold. Year to date, down, or year over year here, and year to date down over 40%. This looks very interesting to us from a play. So we actually were buyers below 850. Not every day you buy the low, but we were accumulating below 850 today. Got a 1% position on in our growth fund in the private equity ETF. If you want to have a look at that, what it looks like and how oversold it is, have a look at this chart going back to the lows that we saw during COVID. And if you want to go back a lot longer than that, you can see that on most of the other major market declines over the past decade or so, with the exception of the great financial crisis, somewhere in this range is really, really good value. Now, if you think we're going to do this again, don't touch it yet. The acuteness of COVID shutting down the world, we're not there again. The valuation is pretty compelling here. Those are a couple bull picks of the week. And on the bear side, so you've been hiding in defensive stocks. Everyone loves their consumer staples. XLP is the way to play that. Have a look at the PE in XLP. 23.1 times earnings in the defensive stocks. It's a crowded trade, folks. And it's not going to bounce very much if we're playing for a bounce here. Look at XLK. This is the technology equivalent. Folks, tech stocks are trading at a cheaper PE than consumer staples. There's a trade there somewhere. Have a great week, everyone.